Hello everyone, guys. I hope so you will be fine. So today we are going to discuss consolidated financial reporting again, and we are discussing today intra-entity eliminations. Like we know, there might be a certain transaction between parent and subsidiary. So while we prepare consolidated financial statements, so all intra-entity transaction, even those are assets or liabilities like receivables or payables, or maybe income or expenses. So those intra-entity transaction we have to eliminate while we prepare the full set of consolidated financial statement, right? So, so please remember here why we need to eliminate all intra-entity transaction, because we assume parent and subsidiary is one economic entity, right? And I cannot perform the transaction with myself, right? So if we assume parent and subsidiary is one one economic entity, so that is why so we have to eliminate all intra-entity transaction, and we will assume that if the intra-entity transaction had never occurred. So here we go, guys. So first thing which we need to eliminate, that is called reciprocal balances. Reciprocal balances mean to say such as receivables and payables. For example, maybe uh, let's assume parent company has receivables from subsidiary. Let's assume 100,000, or subsidiary has payable to parents because subsidiary has to pay. Let's assume 100,000. So these are called reciprocal balances. So while we prepare consolidated balance sheet, so all reciprocal balances such as receivables and payables between a parent and subsidiary are eliminated. We have to eliminate in their entirely. So we have to eliminate all the balance, right? So how you will eliminate, I'm just going to show you, because this first example is just about intra-entity receivables and payables. So for example, let's assume we have a small example here. Uh, let's assume parent company, which is company A, let's assume has a receivable from subsidiary B of 20,000. Actually, company A is our parent company. Okay. And company B is our subsidiary company. In parent company balance sheet, so there is a amount of receivable of 200,000. Okay, and this 200,000 we our company A will receive from the B actually. And in company B, which is subsidiary B, has a payable to company A of 200,000. It means in B's individual financial statements, which is a subsidiary. Okay, so there is an amount which is showing as payable. This payable amount is 200,000. Okay, this payable amount is 200,000. So actually, in B's financial statement, the amount of payable is to amount which will be paid to A, but in A's financial statement, so this receivable amount is from B. So now these are reciprocal balances. So intercompany receivables and payables. So what we will do, so while we prepare consolidated balance sheet, so these reciprocal balances we have to eliminate, and this is the process which we will follow. First of all, we have to identify the receivables and payables which are intra-entity. So we know in company A's balance sheet we have a receivables of 200,000. Okay, and in subsidiary B's balance sheet we have a payables of 200,000, right? Now, so once these receivables and payables are identified, now we have to create the elimination entry, because it's an intra-entity receivables and payable. And how you will eliminate? So this entry we will pass. We will debit intra-company payables, because usually payable is credit. So if we will debit the payables, it means actually we are removing that amount, right? So we'll debit the intra-company payables of $200,000. So why we are debiting payables? To remove the payable from subsidiaries books. Okay, because B has to pay. And then we will credit. We will credit the intra-company receivables, because we know usually normally receivables are debit. So once we will credit it, it means we are eliminating. So we'll credit intra-company receivables of $200,000. So why we are crediting? To remove the receivables from company A's books, right? And now if you will prepare consolidated balance sheet, and in consolidated balance sheet under the current asset section, where you will write parents receivable plus subsidiaries receivable. So we will add parents receivable plus subsidiary receivables minus intra company receivables. So this amount will be deducted here, 200,000, this amount, right? And similar way, once we will prepare current liability section, and once we are dealing with the payables, so we will take parents payable plus subsidiaries payables minus intra company payables. So this is how you will get consolidated receivables. This is how you will get consolidated payables, which will be shown in the consolidated balance sheet. I hope so it's clear, right? So it's a simply elimination of reciprocal balances. Then guys, let me tell you here one more transaction which parent or subsidiaries may have in between. So that is called intra-entity inventory transactions. Okay, intra-entity inventory transactions. So guys, please remember, for example, if we have a parent company and we have a subsidiary company. So parents may sell some inventory to subsidiary, or subsidiary may sell some inventory to parent, right? So whatever intra entity sale of inventory is there, so that we will eliminate. Okay, whatever intra-entity sale, purchase or sale or cost of goods sold is there, that we need to eliminate. Why we are eliminating? Because we assume while we prepare consolidated financial statement, we assume parent and subsidiary is one economic entity. Okay, that we have to eliminate. But if parent is selling any goods to non-affiliated party, non-affiliated party means the third parties. Okay, so that will not be eliminated. Or if subsidiary sold certain goods to non-affiliated party or to the third party, okay, that will also not be eliminated. Only what we will eliminate intra-entity transactions. Okay, now guys, here we have, let me go through some theoretical area and then I'll explain the case wise. Okay, so don't forget, we are dealing with the intra-entity inventory. Okay, number one, guys, please remember here, we know, for example, if parent sells goods to subsidiary, right? So obviously parent will sell goods at certain profit, right? So that profit will be the part of net income of the entity that sold the inventory. Who is selling the inventory? For example, parent. If subsidiary is selling the inventory to parent, obviously subsidiary will have some part of the profit on that sale, and that profit will be the part of net income of the entity that sold the inventory, and here now it is the subsidiary. So this is what is the point number one. So they're saying profit from the sale of inventory between consolidated entities. Consolidated entities means a parent and subsidiary is a component of the net income. They're saying profit is the component of net income of the entity that sold the inventory. It could be parent or it could be subsidiary. Okay, so please remember here. Now let me give you two scenarios here, and then I'll explain what's written here. So for example, if parent sold goods to subsidiary, right? If parent sold goods to subsidiary, and I'm assuming parent sold goods to subsidiary, let's assume goods are 100%. Let's assume, just I'm stating in the state of, I'm stating in terms of percentage. So parent sold goods to subsidiary, let's assume 100% goods. Now what happened? Now let's assume out of these 100% goods, subsidiary sold these goods to third party, how much? 90%. 90% goods are sold to third parties. Like out of this 100%, 90% goods are sold to third party, and still 10% inventory is showing in the subsidiary's balance sheet. Right? So it means this is the first scenario. Like when one entity sells goods to subsidiary, and and or one entity sells goods to other entity, and the other entity sold some portion of those goods to the third party. So this we don't need to eliminate. But whatever intra-entity sale or cost of goods sold are there, or whatever intra-entity profit is there, because in this inventory, which is held by subsidiary 10%, which is still not sold, and this inventory remains on the subsidiary books, it has some portion of the profit, right? That profit we will also eliminate. Why? Because when parent sold goods to subsidiary, obviously there is some part of profit. This profit we will also eliminate. It means in this scenario, what is the scenario? What is the scenario? Let me say one more time. Scenario is one company sold goods to other entity in the group, and the other entity sold some part of that goods to third party that we don't need to eliminate. Okay, because it's this transaction is the third party. So and the other entity also having some inventories remaining on his books. So now guys, what we have to do here, we have to do three things in this scenario. If there is a part sale, he has inventory, some inventory sold to the third party, some inventory still held by the purchaser. So in that scenario, what we have to do? We have to do three things. We have to eliminate intra-company sale. We also need to eliminate intra-company profit on unsold inventory. Okay, why we are eliminating the profit? Because if I will eliminate the profit on unsold inventory, actually my inventory will be back on the cost. So that's why I need to eliminate this amount of profit. Because if I will not eliminate the amount of this profit, so in the subsidiaries books, so inventory will be at the sale price of the parent or sale price of the seller. So, but I want to, because I know in the sale price there is a cost of parent plus there is a profit. If so far in the subsidiaries books, this 10% is on the sale price. If I will eliminate the portion of profit, automatically I will bring inventory at cost. So this is the first thing. So first I will cancel the intra-company sale. Then I will cancel the intra-company profit on unsold inventory, which is held by purchaser. And then third, I will eliminate intra-company cost of goods sold. Okay, so in this scenario, but there is another scenario. What is the other scenario? Other scenario is that, for example, parent sold goods to subsidiary. Goods are 100%. Now subsidiary sold all this 100% to third party. In that scenario, so there is no profit. So, there is no profit remaining on the subsidiaries inventory because everything is sold to the third party. So whatever is sold to the third party, this transaction we don't need to eliminate. Only we need to eliminate intra-company sale. Here we will do two things. We will eliminate the intra-company sale, and we will eliminate the intra-company cost of goods sold. Two things will be cancelled. But if some inventories are still on the buyer's books, then we will do three things. We have to cancel intra-company sale. We have to cancel intra-company profit on unsold inventory. We have to cancel intra-company cost of goods sold. But if parent sold goods to subsidiary and subsidiary has sold 100% to third party, then only we will do two things. Intra-company sale we will cancel, and intra-company cost of goods sold we will cancel. And how you will cancel now, guys? So here we go. Let's have a look with the help of examples. So I'll explain with the help of examples. Okay, so you will understand in a better way. For example, during the year, P sold $100,000 of goods to S. I'm assuming P is the parent and S is the subsidiary. Okay, so P sold 100% of goods to S on the same terms as sales made to the third party, but it's an intra-company sale, right? Intra-company sale. Now, S sold 90% of this inventory to others. Okay, 90% inventory to others. So then what? It means still there is a 10% inventory which is held by a subsidiary, right? As unsold inventory. Then as cost of goods sold in connection with these outside sales are 90,000. So if you will go through this question, here first of all we have a parent. Parent sold goods to subsidiary for how much? 100,000. Out of this 100,000. Now obviously parent has recorded the sale at 100,000 and subsidiary has recorded the inventory at 100,000 because he purchased it. Okay. Now what happened? Subsidiary sold these goods to third party, 90%. 90% is sold. 90% mean to say 90,000. 90% of this value, right? And 10% still he is having unsold. 10% of this value will be how much? 10,000. Right or wrong? Now what we will do? Now I need concentration. Now guys, please, they are saying that this is what they're telling here as cost of goods sold in connection with these outside sale. This is the outside sale. Is how much? 90,000. I told you how it is calculated. Now P had total sales of 800,000. This is the P's total sales, but intra-company sales only 100,000. So, but total sale is 800,000 and total cost of goods sold is how much? 650,000. This is P's information. So guys, how would you work now? Very first thing. So first of all, you have to calculate seller. Who is the seller here? Parent. Okay. Plantonic is the seller here. P is the seller. So we have to calculate first seller's gross profit percentage, because then we will be able to calculate how much profit is charged by a seller, okay, on this intercompany sale. So gross profit percentage, how we calculate? So we need first gross profit. We need GP, and we'll divide GP with the sale and we will multiply with the 100. This is how we get the GP percentage. And you know GP, how we calculate? GP always we can calculate by taking sale minus cost of goods sold equals GP. So here I'm calculating first seller's GP percentage. Seller sale is 800,000, which I'll write here, minus seller cost of goods sold is 650,000. If I take sale minus cost of goods sold, so 150,000, like 800 minus 650, it's 150,000 is my gross profit. So divided by sale, sale is 800,000 and multiply by 100. So GP percentage is 18.75%. So this is the first thing you have to calculate. Okay, what do you have to calculate? First thing you have to calculate what? Seller's gross profit percentage. Now, second thing you need to know, what is the unsold inventory on purchaser's books? We know on the purchaser books, $10,000 is the unsold inventory. $10,000 means 10%, right? It's as it's given here. I told you here. So now we have to identify unsold inventory on purchaser's books, which is 10,000. And now this we will multiply with the seller's gross profit percentage, which is 18.75%. So this will give you unrealized intra-entity gross profit. Actually, this is the profit on inventory, that inventory which is showing on the purchaser's books. And if I'll eliminate this profit portion, because inventory is still showing at 10,000, which is the selling price of seller, of parent. If I'll deduct gross profit from there, which is, this is the gross profit, which is 1875, automatically my inventory will return at cost, because sale price minus gross profit equals cost. So that's why I need to eliminate this profit, because I want to bring my inventory back to the cost as this intra-entity transaction had never occurred. Okay, so now what we will do? So now we will, once we identified unrealized intra-entity gross profit, now what we will do? We will pass eliminating journal entry. Okay, journal entry we will pass. Okay, so now when we eliminate, so we'll first eliminate intra-company sale. Intra-company sale was how much? $100,000. So we know sale is usually credit. Obviously, when parent sold, he credited the sale that times. Now we will make it debit of 100,000. And then we will credit the inventory, because inventory is showing at 10,000. If I'll remove the profit, inventory will become, it will be available at cost then, right? So in normal inventory is debit. So it means I want to bring my inventory from 10,000 to the cost. So it means I need to credit the inventory with the profit portion. So I'll credit the inventory with the profit portion. And whatever the difference is there, whatever the difference is there, so that will be that difference will go to the cost of goods sold. Actually, this decreases the sale, this decreases the inventory, this decreases the cost of goods sold. Okay, all three things are decreasing. Okay, so this is eliminating intra-company sales, this is eliminating intra-company cost of goods sold, and this is eliminating inventory, right? Because we are bringing inventory from the selling price to the cost. Okay, so now once we will prepare consolidated balance sheet or income statement. So once we will write sales there, so we'll write sales of parent plus sales of subsidiary minus intra-company sale, this value. And once we'll write cost of goods sold, in the consolidated income statement, we'll take cost of goods sold of parent plus cost of goods sold subsidiary minus intra-company cost of goods sold with this figure. And once we'll prepare balance sheet, and there we will write inventory. So we'll write parent inventory plus subsidiary inventory minus this unrealized profit. Okay, 1875. So these will produce consolidated figures. This is the consolidated figures for sales, consolidated figures for cost of goods sold, consolidated figures for inventory. Understood, guys? Now another scenario. So please don't forget here, parent sold goods to subsidiary for 100,000, but subsidiary has sold only 90% of that goods to the third party. But in the other scenario, if parent sold goods to subsidiary, for example, parent sold goods to subsidiary and subsidiary has sold all 100% goods to the third party. In that scenario, you will do two things only. You have to cancel intra-company sale and intra-company cost of goods sold. So because you don't have any unrealized profit on intra-company inventory, because there is no inventory held on the purchaser's books. So in that scenario, what we will do, we will eliminate. Okay, we will pass the entry. We will just, if for example, let's assume that S, which is subsidiary, sold all of the inventory. There was a sale of 100,000 inventory from parent to subsidiary. Now all these goods are sold, okay, to the third party. Okay, to the third party. It means we don't have any inventory on the unsold inventory on the subsidiary books. In that scenario, only two things we will do. So year end eliminating journal entry, we will debit the sales and credit the cost of goods sold with same value. Understood, guys? I hope so it is clear. Okay, now guys, we have one more intra-entity transaction. So this intra-entity transaction is what? It's about non-current assets. Sometime maybe parents may sell some non-current assets to subsidiary. And obviously, if parent is selling or if subsidiary is selling any assets to the other group members, so there would be a or loss on gain or loss on the sale, right? And this gain or loss on the sale is recognized by the seller, right? By the seller. Now, please remember, this is because again, this gain or loss on the intra-company or intra-entity transaction. So this gain or loss we have to eliminate. Plus, we have to do a lot of other things also. So that I'll explain with the help of examples actually. Okay. So just I'm trying to explain here how to deal with the intra-entity non-current asset transactions. Okay. So let's go through with the help of examples, because if I'll explain only theoretical concepts first, so you will not understand properly. So here we go. Let's start with the help of examples. So we have an example here, guys. And I will tell you whatever adjusting entries we will pass. This I'm telling you direct adjusting entry, which we will pass for consolidated financial statements. So here we go. On the first day of its fiscal year, I would say at the start of year, P parent sold equipment. Equipment means say assets to subsidiary for 99,000. Actually, this is the selling price of the asset. Okay, then the equipment was originally purchased by P. Like P who sold this equipment, he purchased this equipment 3 years ago. And at that time, he paid it for 120,000. So this is the cost of asset sold. Cost of asset sold. Okay. Then, and it is bought 3 years ago, don't forget. Then P depreciated the equipment using the straight line method, because P has used 3 years now. So P has depreciated these assets on the straight line method, and the life was 8 years. Total useful life is 8 years. Okay, but P has used only this asset for 3 years. So with no salvage value. Okay. Now, guys, stop this question here. First, we have to calculate here first figure. What is the gain or loss for the P? Gain or loss for the P. So gain or loss, because parent sold, right? So for the parent, we are going to calculate gain or loss on this disposal. Because this gain or loss is showing in the parent's income statement, and this we need to eliminate, by the way, because it's an gain or loss on the intra-company sale. So gain or loss, we know how you calculate. We always need selling price of the asset. Because in the question it told you we sold this asset for 99,000. From there, we always deduct carrying value of asset. Okay, carrying value of asset. Carrying value, how you calculate? Cost of asset. This asset was purchased for 120,000 and will deduct their accumulated depreciation. This is how you will get carrying value. So accumulated depreciation, this is how we can calculate. Depreciation, we have to apply straight line method. And he told you total life is 8 years. So depreciation expense first find out. So depreciation formula will be cost of asset, which is 120,000. Salvage value told you 0 and divided by 8. I believe depreciation expense will be 15,000 per annum. Okay, just recheck. 120,000 divided by 8. So 15,000. So, but we need accumulated depreciation for 3 years because we use 3 years. So it will be 45,000. So accumulated depreciation is 45,000. So 120,000 minus 45. So I believe 75,000 is the carrying value. This is the carrying value. Now sale price is 99. Carrying value like of the asset which is sold by the parent is 75. So it means there is a gain because sale price is more than carrying value. So there is a gain, how much? 24,000. So this gain we need to eliminate first because it's a gain on intra-company sale. So this we need to eliminate. And once we eliminate this gain, so I'm just showing you this gain is calculated here also. You can go through this explanation. Okay. So this once we will eliminate this gain. So you know gain is usually credit, right? If you want to eliminate it, so we will debit now. We will debit the gain on sale of equipment. $24,000. Okay. This is the first thing. Second thing, you have to deal with the depreciation expense. Okay, because first assume because assume, please, you have to understand depreciation expense I'm working now. Like what adjustment we have to do for the depreciation expense? This was the parent and this is the subsidiary. And parent sold these assets to subsidiary for 99,000. Right? But in parents' books, what was happening? Okay, what was happening? So cost of asset in the parent book was 120,000 because he bought it for 120. But the cost for subsidiary is 99,000 because he bought from parent at 99,000. And parent was depreciating, right? Parent was depreciating 15,000 per annum, right? I just showed you how parent was working with the depreciation because cost was 120 minus salvage value was 0 divided by life was 8 years. So it was 15,000 per annum, right? So the depreciation, for example, accumulated depreciation for previous 3 years, it was 45,000 plus accumulated depreciation for the 4th year. Because now we are preparing consolidated financial statements, for example, in the 4th year, right? Okay, 4th year. Okay, accumulated depreciation, please, you have to remember. So the accumulated depreciation, okay, will be 15,000 you will add for the 4th year because this 45,000 was at the start of the year, you know, because we sold at the start of year, if you remember. But at the end of year, see, on the first day of the fiscal year, so we sold. Now, if you are preparing consolidated balance sheet, so that has to prepare at the end of year. It means one more year is passed, right? So this is what I'm telling you. So accumulated depreciation will be 60,000. Okay. So it means carrying value should be at the end of 4th year. Carrying value should have been how much? 60,000. But what should be the carrying value? You have to focus. This 15,000 I have added year 4 depreciation. Okay, guys. Now, what happened in the subsidiary books? Subsidiary bought these assets for 90. It's cost 90, right? Because he bought at the start of year. So what he will do now? So once he will calculate the depreciation. So we have to deduct accumulated depreciation. And here he has to take accumulated depreciation only of 1 year because he bought the asset at the start of this year. So how he will calculate the depreciation? So depreciation expense. He will take cost. Cost is 99,000 for subsidiary. Salary value 0 and life remaining is 5 years, right? Because 3 years already gone. Total life was 8 years. 3 years already parent has used. So remaining life is 5 years. So we'll depreciate 99,000 divided by 5. So it is 19,800 depreciation expense. So this will be the accumulated depreciation. And the carrying value in the subsidiary books should be how much? 99,000 minus 19,800. It is 79,200. Okay, now this depreciation is also year 4 depreciation, right? Year 4 means this is the only first year for subsidiary, but actually it is year 4 in total, right? Now what we have to do, guys, now what depreciation expense or what adjustment we have to do for depreciation expense? Because when we prepare consolidated financial statement, we assume as if this entry transaction had never occurred, then what should have been the result? Okay, if this intra-entry transaction should have never, if this intra-entry transaction had never occurred, then what should or what should have been the effect? This is what we have to think this way while we prepare the consolidated balance sheet. Okay, so if this intra-entry transaction had never occurred, then in year 4, this should be the result, right? Cost should be 120,000. Accumulated depreciation should be 60,000. Carrying value should also be 60. And year 4 depreciation should be 15,000. But parent has shown depreciation how much? 19,800. So actually the depreciation which we should have recorded 15,000 should be the depreciation. 15,000 should be the depreciation. Okay, but subsidiary has recorded how much? 19,800. How much subsidiary has recorded excess depreciation? They have recorded 4,800 excess depreciation. So this excess depreciation we need to eliminate also. Because if intra-entity transaction had never occurred, okay, between parent and subsidiary, then this should be the depreciation expense in year 4. But they have recorded 19,800. So excess depreciation we need to eliminate by 4,800. And once we'll eliminate this excess depreciation, so we will credit the depreciation expense by 4,800. Okay, asset, because cost of asset, I'll tell you, cost of asset, guys, how much? Original cost was 120,000 and subsidiaries cost is how much? 99,000, because this we have eliminated when we sold, when parents sold the asset, and this has been recorded by subsidiary when he bought it. But we have to think if this intra-entity transaction had never occurred, so then what we have to do? So we have to bring this asset from 99,000 to 120,000. So it means we have to increase the asset by 21,000. So this is what is the next transaction. Okay, so we have to dabber the equipment because we have to increase the assets. Okay, we have to increase the assets from 99,000 to 120,000. So that is why this 20,000 we will dabber. Now, guys, last adjustment is there. That is for accumulated depreciation. Accumulated depreciation. And accumulated depreciation, how you will adjust? Look at here. Now, accumulated depreciation, we also need to adjust. Actually, if this transaction had never occurred, then the accumulated depreciation for 4 years should be how much? 60,000, right? In the parent. But accumulated depreciation in the subsidiary books is showing how much? 19,800. Actually, this now we have to bring this accumulated depreciation from this value to this value. This is already showing in the subsidiary books, but it should have been shown 60,000, right? So now the difference we will add to the accumulated depreciation, and the difference is going to be whatever difference is there. So that with that difference, we will we will credit the accumulated depreciation. So it means four things we have to do, guys. Number one, I'm telling you, first of all, you have to eliminate the gain. If there is a gain, so gain will be debit. If there is a loss, loss will be credited. Then we have to increase the equipment. Okay. In this example, how it's the difference of original cost, which is 120,000, and the cost to the subsidiary, which was 99,000. So we will debit the equipment. Okay. Then what we have to increase the depreciation also, which is the difference of accumulated depreciation of parent and accumulated depreciation of subsidiary. Okay. And then we need to deal with the depreciation expense also, which is the difference of depreciation expense of parent, which is 15,000. And actually, we have to decrease the depreciation, okay, which is 15,000 for parent, and it was 19,800 for subsidiary, because this is already showing. So, but it should have been shown 15,000. So we have to reduce. So these four things you have to do. I hope so it is clear. Is that clear? Please, guys, confirm through the chat option. Now, guys, I have already told you about this. Actually, this is about the debt. Sometime, for example, parent may have investment in the subsidiary through the debt. Okay, or maybe subsidiary is having investment in the parent through the debt. For example, we may buy the bonds. Actually, this calculation is not in US syllabus, but you should remember just theoretical point. So when one entity holds the debt securities of another entity, for example, parent is having bonds of subsidiary, or subsidiary is having bonds of parent, so with which it is consolidated. So then what? The elimination is treated as extinguishment of debt. Like we will treat as retirement of debt, or this debt is settled, because parent cannot give loan to subsidiary if they are a single economic entity. I cannot give loan to myself, right? So that is why we will treat it's extinguishment of debt. So with recognition of a resulting gain or loss, so we'll treat as we settled the debt. Okay, and whatever gain or loss on settlement is there, so we can adjust. So but this transaction is not there, guys, in your syllabus. I'm just telling you. So this note you have to remember: all accounts related to debt, whatever accounts you have related to debt, such as maturity amount, interest receivables or interest payables, and interest income or expense. Because if one company has to pay interest, other has to receive. For one it is expense, for other it is income, right? So all these things must be eliminated. This is what is extinguishment of debt. Okay. Then if you have any related premium or discount on the debtors and creditors books, we studied the accounting for bonds, these things we discussed there. And any related amortization is also eliminated and recognized as a gain or loss on extinguishment in the period of purchase. Okay. So this simply you have to remember: if you have any intra-company debt, right or wrong, so that maturity amount, interest receivables, payables, everything is eliminated. If you have any premium discount on debtors or creditors books, it is also eliminated. But if you want to know the accounting for this extinguishment of debt, so I have uploaded video on YouTube, but at that is not relevant for you for your exam. Okay. But if you want to see, there all these things has been discussed. Okay. So same thing you have to do. Then, guys, we have here last thing, a reciprocal dividend. This I have already covered in the last class. Like when, for example, you know, we let's say if parent is having investment in subsidiary, right or wrong. So parent is having. So obviously, when subsidiary pays dividend, so whatever dividend paid to parent, that we will eliminate, and whatever dividend paid to NCI, that will be deducted from NCI calculations. Okay, this dividend from subsidiary, which subsidiary is paying. Parent share will be eliminated because it's intra-company, and dividend to NCA will be deducted from NCA. But whatever dividend is paid by parent to the third parties, so that amount of dividend is deducted from consolidated retained earnings. This is what is reciprocal dividend. I hope it is clear, guys. If you have any question, you can ask me.